Hey there, Blockhead Traders. Here at Blockhead Traders must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions from your own financial conclusions and make your own financial decisions. This is Blockhead Traders for the week of February 1st, 2026. And in this week's episode, we are going to do the fourth installment in our investor mini-series. And this will focus on measuring performance. And it really zeroes in on two aspects of measuring performance. One is backtesting by looking at a baseline backwards to see how you are comparing against a baseline, to see if you are exceeding that alternative baseline or not. The other one is to look forward with some simulations in a probabilistic way to see how you might forecast the ability or probability of your particular strategy to pan out. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know, and we will get it there. But let's hop to the content of this week. And like I said, this is the fourth installment of a 5-part investor mini-series, and this is focusing on measuring your performance. In the very first episode, we really talked about how to just get started in squirreling away money for your retirement and your investment strategies. In the second episode, we really focused in on understanding what different type of asset classes there are and what the associated risks are with those asset classes, and then really kind of call to action to help you look for what is your risk tolerance. So once you kind of have your money squirreled away from getting started, you have an understanding of what asset classes and what your risk tolerance is. That moved us into the third installment of how do you put that money to work. And we talked about portfolio composition, how you can make it up of different percentages based on where your risk tolerances are, based on where your interests are. And we went through a lot of that. Now, in this episode, we're going to focus on measuring performance. And so it doesn't really matter if you pay a financial advisor to go do your portfolio composition for you, to manage your funds for you, or if you look and do it yourself. At the end of the day, we really want to take whoever is the steward of that money, whether it's yourself or another individual, and measure that performance. And we want to say, is this really worth it? And so in this week's episode, I'm going to really drill down into what that takes, how to do it, and what to consider as you're doing it. And then next week, we'll tie all of these things together as I help you walk you through my investor portfolio, how I arrived at it, what I do with it, and kind of bring all of the different bits together in a real life example of my own. Now, measuring performance. And where I really want to start with this is establishing a baseline. And so in last week's episode, where we really talked about allocating the funds to different portfolio compositions, one of the things that I definitely talked about in there was you started at a very basic and primitive level of just what is the percentage of stocks to bonds to crypto as the most bare minimum. And then if you wanted to get fancier, you can kind of decompose each one of those sectors, all of those sectors, some of those sectors into different components, right? You might want to take your total stock market index and you might want to break it into U.S. fund equity funds for U.S.-based companies, and maybe a certain percentage for overseas companies. And all of that slicing and dicing is really how you can keep drilling down all the way into individual components and individual companies. And so when you go to establish a baseline, where I recommend your baseline be is whatever the next step up from where you decided to get fancier in. So if you happen to have only decided to pick different sectors, like here's a large cap fund, a mid cap fund, maybe a small cap fund in different percentages, maybe your baseline would be a total stock market index because that's the next click up from that. And that's really where I would recommend you kind of establish your baseline. Your baseline, you're going to want it to pretty much be anything above where you are. The reason for that is the baseline is kind of your reference point to say, is what I'm doing worth it? So if you decide to get fancy and break down the stock market into all these individual holdings, you should compare yourself to the baseline of the stock market index. So if you decided not to get fancy and you put all of your money in a S&P fund or a total stock market index fund, are you doing better than that fund? And that is a key metric that you can take to consider, is all this time, energy, and effort worth it? And this definitely could be something that you use against a financial advisor. You're going to pay a fee for that financial advisor. Usually a 1 to 2% of your portfolio fee will go to that advisor for his active management. So you will want to have him be able to beat the overall index by 1 or 2% or whatever that fee is, right? If you can't, then the question becomes, what value is that individual bringing to your portfolio, to your investment strategy? And I think you have to take into account not just the returns, right? There are different other aspects that I'll show up here when we kind of look at some of the comparison, because maybe you don't like, from a risk tolerance, you don't like very large drawdowns. And so even though the returns might be less, if the drawdowns are significantly less, maybe that's more comfortable for you. Maybe a standard deviation, how much volatility is in that particular portfolio, which is kind of related to drawdown, but that's how much does it move up and down around its trend line, the amount of volatility in the portfolio. And so all of these things are reasons why you might want to pay a premium. And I'll kind of show that in the portfolio visualizer when I look at the underlyings in the portfolio composition that I have for this example. And really defining that number to beat is very important. And you want to try to keep it as apples to apples comparison as possible, because you want it to be a fair fight. You want it to be a fair competition. You want it to be a fair race. So for example, if you have a portfolio constructed of all these different stocks, individual companies, growth companies, large cap companies, all that stuff, you wouldn't want to pick a baseline of bonds, right? Because that's not representative of the asset class that you have in your portfolio. Likewise, you want to make sure that what you baseline against is representative of your portfolio. And what I mean by that is I'll show you in the example that I'm going to give on Portfolio Visualizer. I can put my whole portfolio in there, and then it says, what do you want to compare it against? But you can only pick one thing. Well, that's not very fair, because that what you pick assumes that 100% of your portfolio is that. And so if you wanted to have a mix between bonds, crypto, and stocks, you wouldn't want to baseline that different composition against purely stocks like a S&P fund. And so that's why I think it's very important to establish a baseline portfolio that you will then compare your portfolio against, and you'll want that composition to be roughly similar to what you're targeting in your portfolio, which is why I said a great place to start would be to go through what's the next level up, what's the simplification of what you've tried to do. So maybe you have large cap, mid cap, small cap funds, right? Well, the simplification of that would be one fund that covers all market capitalizations of U.S. equities, right? And so maybe that's the baseline that in totality adds up to the percentage of funds allocated between your subdivision that you have decided to do. And the key thing here is really, is the value of your time, energy, and effort that you're putting into this worth it? And that's why when you're comparing the baseline should be less time, less energy, less effort, more simplification, right? And so you want to see your portfolio, whether or not it's something you did or your financial advisor did, bring additional value above and beyond that more simplified baseline. And that's really the goal or the spirit of what we're after when we go to measure this performance. So we're going to start here with the Morningstar screener. Now, you can use any screener that you want out there. This is just where I started. So for the portfolio composition that I'm going to cover here in this week's episode, I wanted to have a certain percentage of my funds in ETFs that are stocks. a certain percentage in ETFs that are bonds, and then I wanted to reserve a certain chunk of that for discrete stocks. So basically, where I wanted to say, hey, here's a tiny percentage of my overall portfolio. Let me go ahead and try to pick the next up and coming Tesla or the next up and coming Microsoft or Apple or something like that, right? The moonshots, if you would. And so that's how I wanted to kind of do my portfolio. And so I started off by going to this Morningstar screener. And in here, I said, hey, I want to do investment type of ETFs. I came down, I picked the asset class of US equities. Now, one of the things is I wanted to take and subdivide stock funds. And so you'll see me picking large cap, small cap, mid cap, and then additionally, I wanted funds that were representative of things outside the United States. So I did international equities, and you can kind of pick that in the asset classes. Now, I wanted them to all be big, over $1 billion in net assets. So I basically checked all of those. I also went ahead and looked at only the gold-rated Morningstars. There's a whole metric in here of different things. I said, you know what, let's just go with the gold, and let's look at 4 and 5 stars. And so you can see as I did that from the U.S. equities, there's only 34 funds to look through here. Now, when I wanted to narrow this down, I could go into the Morningstar category and I could look at, large cap blend. And now all of a sudden I'm only looking at 3 different funds that are really covering that large cap index there. And so you kind of have 3 main sectors. You have small caps, mid caps, and large caps. This is the market capitalization of the company. And this is really where I started to generalize and to make up the portfolio composition. Now let's jump over here to portfoliovisualizer.com. And this is where I have a couple of saved portfolios. The ones that I want to zero in on here are IRA portfolio and IRA baseline. So the IRA portfolio, this is the portfolio of the hand-picked things that I took to put inside of that. The IRA baseline is the baseline or the step up or the simplification from where I decided to get fancy with my picks. And we want to zoom in here. There's basically just 6 funds in here. 35% are in a large cap fund. 15% are in a mid cap fund. 5% are in a small cap fund. Then here I've got my VEU, which is an international fund. VTIP is what I chose for basically bonds. And 20% is in there. And I reserved 15% in basically cash. So it's listed here as 3-month treasury rate, just to put it as a threshold or a placeholder. But this is where I would pick individual names. So this is 15% of my overall portfolio is going to be dedicated to discrete stocks that I decide to pick, buy and sell, dips and moves and stuff like that. So I should have a steady Eddy portfolio of bonds and funds, but then I'm going to go ahead and try to sprinkle in some alpha. And this is where that reflection or that look back is going to be important as my portfolio goes on, because what I choose to put in there will largely show a differentiation or lack thereof, depending on how well I do. So simplifying that is taking that backwards one step. And so the 6 things that I had could be simplified here to 3. VTI, total stock market index, that's going to be 65%. BND, that's a total bond index, that's going to be 20%. And then I decided, since the treasuries, I'm going to go ahead and put the 15% in the S&P, because ultimately when I pick a stock or an offering, basically the S&P is probably the closest thing to that. So this is the baseline. Now, that 15% is going to be a little bit wonky to look at when I compare, because I haven't picked those individual names yet to look through there. But that's okay. Just know that is a discrepancy that will be there. Now that I have both of those picked and understood, we can kind of look up here at the customized data. And what this will allow us to do is it will allow us to go ahead and pick the portfolios that we want to do a comparison of. And so I'm going to pick the portfolio of my IRA portfolio, and I'm going to compare it to the IRA baseline. So picking that from the drop-down, we'll go ahead and populate the composition that I previously showed you, and we'll be able to come down here and say, analyze these portfolios. Now what you can do is you can get a scroll down here and you can see. So the very first one is my IRA portfolio. The highlights here are a couple of notable values. So this has a portfolio return of about 9.1%. It has a standard deviation of volatility and drawdown of a 9.5% and a maximum drawdown of 16.7%. What that basically means is the volatility or movement is about 9.5%, which is pretty decent. Drawdown says, hey, the biggest drop in total net asset values was 16.7% in a one-time drop. So that's a drop that can recover, but that's why it's called a drawdown, is because that is a single day's pull down, or a single period of time, I should say, pull down of your portfolio. And if you continue to scroll down, we will go ahead and see what the baseline looks at. So this is the baseline with those three tickers and a couple of notes here. You'll notice that this portfolio return was higher than my portfolio return, coming in at 12.6. There's a couple reasons for that, most likely. One of them is that discrepancy where, remember, in my portfolio, I took that extra 15% and I stuck it in U.S. Treasuries. The return on that is going to be very poor. Whereas in the baseline, that was compared against the S&P fund. So that's going to have a higher return than U.S. Treasuries. That's going to factor in a little bit to this portfolio return. But you can pick and choose, and you can zero down in that top form if you want to go between this fund and that fund and really see where that plays out. Now, of note here are the volatility and drawdown. You'll notice that the standard deviation is higher in the baseline portfolio. That means there's going to be more price fluctuation, more swings up, more swings down. That may or may not be useful to you, right? Some people in their risk tolerance don't like a lot of those big swings, and so they might want a lower standard deviation. Additionally, the drawdown is actually significantly higher. So in mine, it was a 16% maximum drawdown over looking backwards when it was backtesting. However, this portfolio composition had a much higher drawdown of 23%. And so these are all, when I say, is this value add to you? Things that only you can answer, right? Maybe it's not all about just the return, right? Maybe some of that, what you get is how comfortable are you? Maybe you don't like to see big drawdowns on your retirement account. In that case, the baseline here would be less value to you because it's not as stable. Sure, it might return higher, but if that stability, you place value in it, then that's what you have to consider when you look at here. Now, if we keep scrolling down, there's other values that they want to put in here. Performance summary, you can look at all this stuff. They visualize the portfolio growth. And I'll stop here on the portfolio growth visualization because the green line is the IRA baseline that we talked about. The blue line is my portfolio. And what you'll see is, yes, the green line does have a higher performance in the end. That's where that extra, percentage of return comes from. But if you look, there's more swings up and swings down. This is the volatility that we talked about, or that standard deviation of volatility. Additionally, the maximum drawdown. You can see that, yes, the blue line does decline, but it doesn't decline as much with as much value as the green line. And so it's a lot more of a steady eddy trend line up. And scrolling down through other things here, they do the annual returns. They will go back as far as the funds allow. So this only goes back to 2013 because there's not enough history in the funds that I have picked that go back before 2013. So depending on what you choose, your graph might go further back in time. And there's a section at the top where you can say, hey, even if it goes back to, say, 1985, I only want to look at since 2000 or whatever it is, right? Those are all parameters that you can mess around with in that customized data area at the top, which is where I put in those portfolios. There's many, many, many settings that you can tweak in here. The point is that this really gives you a very good comparison of back testing different portfolio compositions. It gives you trailing returns. It gives you holdings based on style analysis. You get different asset allocations, market equity differences between the portfolios. Just a really, really holistic and detailed thorough deep dive into the portfolios. You can actually put 3 of them in there at once, or you can slice and dice, manually change things around. Where we had that Portfolios, you can change this to really any ticker. It shows only 10 here. You just click more and you can add more. I have had up to 30, 35 different tickers in here to look at different compositions. I find it's a little more difficult when you have lots of things, but if you want to compare this or that, you can simply, put 100% of funds in one, 100% funds in the other, push or analyze. There is really a ton of flexibility to do back testing, look backs, performance metrics, things like that. Now, this is really only half the story, right? This is all looking at life through the rearview mirror. This is going to give you, hey, this is historically how this fund performed, but it doesn't really give you that warm fuzzy on what's going to happen in the future, because futures are really hard to predict. That's where simulations come into play. Now, when it comes to predicting the future, this is where simulations are your friend. And one of the most common and the most popular types of simulations that are out there is called a Monte Carlo simulation. This is named after the Monte Carlo casino and kind of gambling, if you would. But what it does is it's a model that's used to predict the probability of a particular outcome given unpredictable variables that are going to go in. And the way that this works is the computer runs algorithms and calculations off of all of the equations going into this, but they take all of those random values that are uncertain from the market. They plug in values into that of a very large number, and they run the simulation again and again and again, and they take all the different permutations of those uncertain values, and they say, okay, what was the end result given when the values were X? Okay, what was the result when the values were Y? And what were the values were Z, and basically Z prime, and Z double prime, and Z triple prime, basically all the different permutations of those unknown things to the thousands and thousands, right? And then it measures how is the outcome of that and puts it in a statistical distribution so that you can say, hey, given these particular things over a statistically significant number of random values plugged in for the unknowns, this is how the simulation performed. And so there's two ways that I like to use this when it comes to investments and retirements. So the first way is what I think is more important for your particular portfolio composition, and that is focusing on, okay, given this particular portfolio composition, what is the probability of my return after 5 years, after 10 years? And it'll give you a range of the different statistically percentiles of what does it fall into. And that's the first way, right? That's to predict the building of wealth. The other way that you can use the Monte Carlos is once you have a pile of wealth, you can use this as forecasting when you try to draw down on that account. So maybe you've entered your retirement and you have a nest egg of, $2 million. How many years is that going to last you? That's something you can feed into the Monte Carlo simulation to say, okay, I have this much assets. Here are the assets that I have. I'm going to assume a 4% drawdown of withdrawal rate to live off of. What are the chances that the money that's left over will continue to appreciate, and how long will that money last, and what's the different probability statistically of the longevity of that fund. Now, where we'll look into that is back to portfoliovisualizer.com, and they will have as one of their simulations, portfolio simulation, and you can choose Monte Carlo simulation. There's a very good write-up here of what is the Monte Carlo simulation, how does it work, how does it function, and then what we'll do is we'll kind of come down here where we set a lot of the parameters going into that. And so one of the things I'll do is, because we want to monitor the portfolio configuration that I have of the IRA, and so instead of doing a portfolio type of asset classes, we're going to go ahead and change this to tickers. And that will give us more of a ticker-based, which they want you to enter what are the portfolios. We can go ahead and call up the IRA portfolio that I had pre-entered already in there. And then it is going to go ahead and populate the sheet with all of the IRA holdings that I have and the percentage of allocation, as you can see here. Now, you can also kind of come up here and say, hey, what is your withdrawal amount? Now, we don't want that. We want to basically do, hey, with contributions, how can I grow this, right? So let's just say that they contribute a fixed amount periodically. So I'll pick that. We'll say, hey, I've started with just $10,000. And let's say that I'm going to go ahead and add $7,000 a year. Now, that's the maximum IRA contribution rate that you can give. You would set this annually. You have your portfolio. So let's go ahead and run the simulation. Much like the back testing, there's going to be a lot of values that come back here, but this is the portfolio simulation for a 30-year period. There's the portfolio. They talk about the performance, what's in the 10th percentile. So basically 90% of the time, I earned more than 6.83% return on that portfolio. The 90th percentile, that's the very top percentile, that portfolio returned 11.4% or greater. 10% is a 10% chance it will perform at that level. And if you kind of keep scrolling down, this will show you this range, right? So here it is. Each of these colors here is a different percentile. So assuming that you fell in the 10th percentile, right? So this is the worst case, I would say very close to the worst case scenario. Statistically, your portfolio goes from, in 30 years, goes from $10,000 to almost $1 million, $952,000. Now, the best case scenario in the simulation would be that dark blue line. That's the 90th percentile. And there we went from that $10,000 30 years later to $2.3 million. Now, this is with a $7,000 increase each year to go into that. But this is really where, and you get a statistical distribution here of, the frequency, the number of times that it fell into each one of these particular buckets. So about 1,200 of the runs fell with a $1.4 million end value. And this is the statistical distribution across putting those random numbers in all of the unknowns as far as the model goes. And this really gives you that probabilistic outcome of where you might sit given your particular portfolio composition. Here is the number of max drawdowns based on the simulation. So you can see there was a very high number of max drawdowns, a little bit above the 18% mark. You can see in some of the simulations we had drawdowns as high as 34%, but this is the number of occurrences. How many times did this hit given where the max drawdown was? Now, as we kind of keep scrolling down here, there's a lot of other values in here: simulated assets, correlations, and returns, expected annual returns. This talks about what is the average annual return after year 1, 3, 5, 10, 15, kind of putting all those together in the different percentiles. Annual return probabilities. So what is the probability of a greater than 12.5% return in year 1? We got almost a 54% chance. And you can see that maintaining a greater than 12.5% return after 30 years, annualized every single year, is less than a 3% chance of actually achieving that. And so this gives you what is the percentage probability of each of these returns over that period of time. What's your biggest loss probability? Where does that fall? What are the statistical distributions? And really just a very thorough estimation, probabilistically, using data, using statistics, on what does this portfolio composition mean moving forward. And so I think this is a very, very important piece to take into account when you come up with your portfolio composition, because this will give you the probabilistic values to say, is this matching what you need it to? You could change your starting portfolio. You could change your contribution rate. You can change the length of time that you're running this. And all of this is what I want to bring up because it helps you visualize, is your plan, what is the probability that it's going to attain you what you want to have later on in your life to reach your goals. And so Portfolio Visualizer has this Monte Carlo simulation built in. I would say anything you're really looking, there's two aspects of looking at it. There's back testing that is going through the rearview mirror. And then Monte Carlo or simulation is kind of looking forward, which is never certain or not, but it gives you get a probability, then you can have hey, what's my confidence level in this? What is the probability that this will turn out a particular way? So that really brings us to the end of this measuring performance. And I really, really think this is super important because it helps you have confidence in your strategy or your financial advisor strategy or whatever strategy that you came up with that you're using for your assets. It lets you, one, back test it looking through that rearview mirror to say, hey, historically, how has this panned out? And comparing that to a baseline is so important because just your portfolio in and of itself, you don't really have is this worth it unless you have something to compare it to. And you always want to try to compare that to something more simple, more basic, more less costly, because you have to decide if that delta that you have engaged in to manage it yourself, to go seek a financial advisor and pay him extra money, him or her extra money, is that worth it from a value standpoint? And that's why adding that other portfolio baseline to that comparison is very helpful because it helps you understand and justify if that extra that you have taken on is worth it to you. And just looking backwards is not really enough because time moves forward. And really what matters is what's going to happen tomorrow, what's going to happen the next day, what's going to happen 10 years from now. Now, there's no way that you know what the future holds for certain, but that's where simulations and probability come into play. And that's really where the Monte Carlo really, really shines because when you take all of these models, all of these statistical distributions, once you have an algorithm there with a bunch of unknown variables that can just not be known, that's where you need to plug in hundreds of thousands of iterations of what that value could be and see how the model pans out. And then once you have all those hundreds and thousands of data points, you correlate that into a probability that says, hey, this percentage of the time this happened given all of the different various inputs. And that helps you kind of craft looking forward. How is this particular strategy going to pan out? What's the likelihood of it? And you can take this, the way Portfolio Visualizer has this all laid out, you can take your financial advisor's plan and you can input it in here. You can take your plan and input it in here. You can take the plan that you read about on the internet and put it in here and see how it pans out. And it really helps you validate, tweak, and tune some of those things to see, is this going to meet your expectations? Is this going to meet your financial goals? And I really think that's very, very important because if you lose sight of these anchors, then you won't really have a point of reference to know, is this good? Is this bad? Are things going well? Could I be doing things differently? Could I be doing things better, different? And so kind of measuring it is very important. Now, one thing that you have to keep in mind when you go to measure these things is what is your time horizon? And so it's important to maybe establish when you want to do these measurements, when you want to do this comparison, right? So once you've established a strategy, right, and you run your Monte Carlo simulation, you run your back testing, you're like, cool, I'm ready, let's rock and roll, let's go with this. Don't run this every single day and try to pivot or change every single day, right? If your time horizon is years, decades away, making adjustments daily or weekly does not make sense. So you have to balance your particular time horizon with when you're going to go and measure and make adjustments and make frequencies. Otherwise, you're going to flip all these knobs and switches too often, which is actually going to detract away and kind of dirty the data and make it not as statistically significant or correlated if you do that. So a lot of times I would say quarterly is probably going to be your most frequent reassessment of things. And this is after you come up with the initial strategy. So while you're coming up with a strategy, before you start putting funds in, run these simulations, tweak, run it again, tweak, run it again, tweak, run it again, until you zero in on what you want to roll with. Now, once you roll with it and you start building your assets and building your wealth in that area, hold steady, right? This is where you're going to review it quarterly. Maybe you rebalance quarterly. Maybe you rebalance semi-annually. Maybe you do it annually, right? But I would say you probably don't want to do it any more frequently than quarterly. In very rare cases, if your time horizon is very short, you might consider monthly, maybe. But when I say time horizon short, I'm thinking you're dealing with a 5-year goal or maybe 3 to 5 year goal versus a 10 to 20 to 30 year goal. If you're on that kind of time horizon, 10, 20, 30 years, do not tweak this any more than quarterly. If you have a very short pitch goal where you're talking less than 5 years, you might want to consider monthly, maybe every other month. But even quarterly at that rate is probably okay. Now, one of the things that Portfolio Visualizer can take, although I didn't pull it up in the example, is you can input expense ratios, you can input fees, you can input costs, right? And so if you have a particular financial advisor and he's going to cost you X dollars of money in returns, you can actually put that in the simulation. And then maybe your comparison is your own portfolio without that extra fee. And you can project and see probabilistically where those fall, whether or not it's worth it to go with that extra financial advisor cost. So that can even be part of your baseline. Remember, your baseline is a more simple version of what you are moving forward with. And there's really no rule on how more simple you make that. It's just wherever you're comfortable with. And so that's why I think you should take one step backwards in simplicity. If you want, you can take 2 steps backwards. You can compare against multiple baselines. The core goal here is to say, is the delta of time, energy, effort, cost, whatever that cost is measured in, worth it for that strategy versus a more simple, less costly, less resource intensive one? That's the premise. That's the spirit of that. So hopefully this helped you frame up a little bit about measuring performance around investments and retirement and those longer term really investor mindsets. This is not about trading. This is really about that long-term, high time horizon entity. So good luck out there. Have fun. And remember, think outside the block.